Good afternoon, everyone. I promise I'll try and make this as painless as possible. I know it's late in the day. I must admit I feel now very sorry for myself. Kartik, I don't know how I'm going to follow that. For the rest of you, I can make one assurance: it's not going to be as good as his presentation. Just to introduce myself, my name is Shaun Heelan, and I'm here representing Maat Investment Group. We're a new firm, less than 2 years old. It's four of us who came out of another firm called Paradigm Capital in Munich, which some of you may know, along with a fifth person, Jenny Nagan, who's running business development. We focus only on European small and mid-cap companies, and we're somewhat algorithmic in capital allocation. So we like to think we're the best of fundamental and quantitative mixed together. Before I get into the idea, I just want to say a very quick thank you to Christian and Maria for organizing this fabulous event. I don't think I'm imagining it when I speak for everyone that it's been really well organized. The logistics are great. Everything about it's wonderful, especially the crowd that's here. All right, so that's enough about that. Yeah, I think a round of applause. Thank you very much. Thank you very much. I hope I get invited again next year. So before I get to the idea, I got some advice from my wife before I come on stage. I'm not the greatest presenter. Just to set expectations, she told me, the only thing you need to do is not fart on stage, and that way people will be fine with you. So I'll try and hold it to that standard. So I'm just going to lower the expectations here before we get into it. So a very quick trigger warning for your attention as well. If you are restricted by ESG, you're not going to like the company that we're presenting here. It's a gambling supplier. If you're restricted by size, it's a market cap of around 270 million euros. You're also probably not going to like it very much. With that proviso in there, we'll get to the things that you might like about it. We think there's two. Sorry, wrong button. So the company in question is called Kambi Group PLC. It's a Swedish company. The two things we think that all investors will like about this features are, first of all, we think that the downside is incredibly low to negligent. We think it's very hard to lose here over 2 to 4 years. We would like to phrase it as bond-like downside. As a former bond trader, that's kind of my moniker. So very difficult to lose. Why is that? Simply, it's free cash flow positive. The free cash flow is going to grow going forward. It has a net cash position, no debt on the balance sheet, and it is trading at below replacement cost. Getting to what the business does, as I mentioned, it's a sportsbook supplier. So what does that mean? Well, sportsbooks for gambling companies, if you've been to Ladbrokes, DraftKings, anything like that, BetMGM, you may have used it. It's actually a low margin business for these companies, and it's a bit of a lead generator. So it's something they tolerate. They make some profit on it, but it's really to lower the CAC and to lengthen the LTV. The problem with it is that it's much more complicated to run than the rest of their business. The reason is that you're betting against other people. Those bets have informational value. If you go through the geometric math, if you do parlays, it's incredibly difficult to manage well. So Kambi was set up to handle that problem. They looked at it the same way that we as investors may think about how we handle analytics or EMS and PMS. So in our case, maybe we go with Bloomberg. They had the idea that there were lots of gambling companies were coming out after legalization in Europe, and they would have the same problem. The market that they were coming into was small and fragmented. That's in the UK, Holland, the Nordics, you name it. The US wasn't yet legal. So fragmented by country, fragmented by company, relatively small companies. And they said they've got a problem to solve. We can create an excellent analytics platform so not everyone has to reinvent the wheel. It was a very good idea, and they executed it on the product side extremely well. So they have the best product in the space by far. Most of their competitors have now exited the market because of tough economics. They've won award after award pretty much every year for the best sportsbook supplier. You won't find anyone in the industry who argues about that. The only one who's got something better are the big companies like Entain and Flutter, Bet365. That's about it. So that's the positive side of this. The negative is what's gone on with their business. So despite having the best product, they have not had the best financial results, and they've had customers leaving them. Why is that? Well, we think they were plagued by a poor strategy, both in product and in price, and also that they were, I think, ignorant to changes in the underlying environment. They were too wedded to their original strategy. However, why are we here today with this idea? Things have changed, and most people have not noticed. There's only 3 analysts covering the name, 2 who do it seriously, and serious is about an hour a quarter. So what do they have? A new strategy from a new CEO who's very experienced in the industry. He's not wedded to the old strategy. They have new products that are coming out, a new approach to pricing, and we would go so far and be so bold as to say that we think that they are you will look back retrospectively and say that they have troughed results-wise, both in revenue and profits, between last year and this year, and we'll tell you why here. So to tell the story, we think you need some context. We think we can tell it in 3 areas, roughly. First of all, the rise. You'll see this here. Where did Kambi come from? It was actually spun out of another company. You would know them for their brand if you're from the UK, Unibet. They have lots of different brands. The company is called Kindred. It was spun out in 2014 at a price of 35 a share, appreciated roughly 16-fold for 49.5% IRR over 7 years, and shareholders, along with management, were very happy. That's important because the co-founder was the CIO, was the CEO. It was his strategy that helped build towards this, and he was very, very proud of himself if you're getting to why the strategy maybe got a little stale. The fall is equally spectacular. That's about an 80% decline there from peak to trough. Happened in 4 years. Unfortunately, much more rapid than the appreciation. Why was that? Well, the rise came from having the biggest customers in the space, opening the US market on behalf of the biggest customers. So they took the first legal sports bets in the US, I believe in every one of the first 10 states, did it quite successfully, but unfortunately those customers started to leave and they did nothing about it. They let that go through. And the third stage, obviously, is we think the opportunity is now. We think there's a trough, there's been a change, we'll get to why. We think context is helpful though, further context. So let's go through the rise very quickly. They went from 2013 with 3 customers, negative profits, to 2021, 7 years, 162 million in revenues for a 24% CAGR, 57 million in EBITDA for a 54% CAGR. And you can see there that the share price just followed the fundamentals. It's not that the multiple got so crazy, but there were problems here. You'll see it on the next slide. It is the degree of customer concentration that had gotten pretty extreme. What were the main characters or the main events that happened with this rise? It was really, in particular, the opening of the US market. And you've got this on the chart here on the right with some key events. So first of all, May of 18, they win Rush Street, followed by DraftKings, which is a huge name if you're from the US, if you know it, from fantasy sports betting before that. That was a big, big win for them. About a year later, they get Penn Entertainment. You might know them better for Barstool Sports. And then they had the COVID boom, and they grew tremendously with all of these US customers and their European customers as well. However, the gremlin in the works was already at play, and that was from their, at the time, second biggest customer, what was certainly going to become their biggest customer, forgive me, in 2020, DraftKings. And what they did was they bought the sole listed competitor, SB Tech, and they paid $1 billion for it, thereabouts. This brings us to what went wrong in more detail. And we think that these 2 quotes can kind of illustrate that. So just to reiterate what we think went wrong, we think it was 2 strategic misalignments. First of all, they were inflexible, again, on the product and on the price. And the second one was they ignored the changing environment. So first example here, if we go to the quote on the left-hand side, this goes back to the strategy they had originally. When they were spun out of Kindred, they were dealing with a fragmented, small number of companies who were subscale. They wanted to find the biggest of those customers and reserve space for them. They thought they had capacity limited, so they only wanted to deal with the biggest of that cohort. They were going to be the best provider of the product. Made sense. However, it was kind of arrogant to the smaller players or the faster growing players. They felt somewhat excluded. If you spoke to the smaller customers who were in there at the time, they felt like they were stepchildren or orphans. The second one, which is more concerning, and this goes to the changing environment and a difference in attitude, or maybe denial or delusion, perhaps, depending on which word you want to use. This comes right after the announcement that DraftKings was leaving. Keep in mind, this has grown very quickly to be the second biggest customer, was clearly on its way to being the biggest, and by far the biggest. And moreover, DraftKings had tried to buy Kambi at the time. So when they announced that they were leaving and buying the biggest competitor, what was the reaction? Was it one of fear? One of we're going to change our ways, one of we're going to react positively? No, the reaction was this is an opportunity for us. I think what they were trying to say in this case was that SB Tech's customers would no longer want to stay with a competitor and will come over to Kambi. That's what they were trying to suggest. That's not really the case. A key feature you should know about Kambi is that it only deals in legal and regulated markets. It's the cleanest of the clean in the gambling space. SB Tech was the opposite. They were quite a controversial company, and most of their customers dealt with illegal or gray markets. So there weren't many customers who were going to come your way. So just very interesting. I mean, think about a market that's one of the fastest growing in the world, which is online gambling. You have the fastest growing player in the US market who was your biggest customer, and they're leaving you, and you see this as an opportunity, not something going wrong, and not as a threat. Now, we looked at this company for years. We never invested until recently. Our concern was that this kind of denial or inability to look at reality. Surely somebody else would have looked at this and said, there's a threat here. Why is our biggest or second biggest customer willing to pay $1 billion and walk out on us rather than stick with us? What's going on? And that brings us to the fall. So you can see here, as we discussed, equally spectacular. Over the 5 years from 21 through 25, no growth in revenues. Unfortunately, operating leverage worked in reverse from what it had done the first period. There was a 70% decline in EBITDA, or 28% per year, down to 16 million. Pretty much a disaster. And what was that led by? Well, it turned out that DraftKings was the canary in the coal mine. It was not an exception and certainly not an opportunity. You'll see that Penn, again, Barstool Sports, they decided to follow the lead of DraftKings. And so they bought a company called theScore in Canada, which was the equivalent of DraftKings for Canada, a sports betting franchise, for Canadian $2 billion. Okay, so that's another one of their top 3 customers who leaves and pays about $1.5 billion to get out. And then the coup de grace, and this was like a Shakespearean tragedy, at least in our eyes when we were looking at it, their parent turned around and killed them too, Kindred. So in February of 22, they announced that they had secretly been developing a sports book for 18 months, and they were going to take off too. And this killed all faith in the CEO, all faith in the management plan, and any long-term plans they had to grow. The model had not changed. They were sticking to that, and I'll get to what the model is. Penn officially announced they were leaving later on, but really it was dead in the works there. So you can see pretty obvious decline here. We think, coming forward, to assess whether this is a good opportunity now or whether you can, there are 4 key questions that you want to address. And we'll address all of them here. You can see, is the share price the decline warranted? Why did they lose customers in more detail? Why did they fail to attract new customers to replace them? And again, ultimately, why is this the opportunity? So let's get right to it. So I'm coming back to something you saw already, and this is the chart from the fall. So what went wrong? As you can see, 0 revenue growth, you know that already. Massive decline in EBITDA, you know that too. So was the share price decline warranted? You bet, and I think we've just gone through that. But why do we say yes and no? The no is down here, and it's something you may not have paid attention to when I showed you the slide the first time. Down here, you've got a couple of things I think you should look at. This is revenue excluding those 3 key customers, or 4 in some measures over time. And what you'll see is, despite the 0 top-line growth, they were growing at 13% per year, outgrowing the people who left and outgrowing the market for that matter. So underneath the surface, if you take out the headwinds from those key clients leaving, those smaller and mid-sized clients that they tried to avoid in the past were actually growing quite rapidly. So pretty positive underlying growth trend that most aren't aware of. The second thing is the customer concentration. So what you will see is here, this line, back in 2021, the top 3 customers were 82% of your EBITDA. Now, people who were paying attention were aware of that. Not enough did pay attention, but you come forward to today, it's down to actually 36%. We rounded it up here. So the concentration is diminishing. So the risks that laid you low have been getting smaller over time, and the headline growth in revenues is somewhat deceptive. So why did Kambi still lose customers? And for this, I would say I would go back to Darwin. So Darwin famously said, I'm going to paraphrase him here, please correct me if I'm making a fool of myself, but it is not the strongest or the most intelligent to survive, but the most adaptable to change. Well, we think that Kambi, despite having the best product, they win this award. We've only put a few of them on here. They've won this every single year. So by far the best product, very satisfied customers. They failed to adapt to a changing market. We've already addressed that. The European market that they entered had changed by the time you get to 2020. You had fewer and larger players, more negotiating leverage. The US growth was much bigger than they ever anticipated. Their clients grew far too fast, and they did not make it appealing to stick around. In fact, they gave them incentive to leave. These two together made insourcing for those larger clients viable. It might have been better for them to build this in-house, contrary to the original thesis of management. There was one more part, which was the larger asset managers who did love the product and who did have a technical debt, which was the thesis to begin with. They would have taken the product on, or at least good portions of it, if they had been allowed to retain control of trading for themselves. So Kambi had a model where it was take it or leave it. You had to take all of their services, trading, odds feed for everything, or you had to go. And those customers, they really had technical debt, they really liked the product, but that was a hurdle they were not willing to cross. And again, the small and mid-sized customers, They felt that they were orphan children, and also when they had requests for any kind of modifications or changes, it would take months to get through. So why am I paying this high premium? So you had dissatisfied them. So I said the product was inflexible already, but I also mentioned pricing. And I think this is why those customers left. And I think this was a fundamental mistake. To bring it back to Kartik and the chess example, they abandoned the center of the board, and they were naive about that changing environment. So what you have here roughly is an estimate of revenue or GGR for the major sports players. You'll see this here for Flutter, growing very rapidly. That's through acquisition. You've got Entain. These are, I think, the 6 or 7 largest publicly listed companies. Bet365 is not there, and an estimate of their sports GGR. Some of them don't spit this out, so we have to make an estimate here. I would notice that of the bottom here below, all of them have been Kambi customers at one point or another. What you have on the right is just a hypothetical. And what this hypothetical does is it shows you how Kambi prices and what went on here. So what we're assuming is to run a sports book, which is a really difficult, complicated thing to do. This is really, really hard. It's like correlation trading. We think it would cost you, of a similar standard, roughly 50 million a year and several years to set up, and an ongoing cash OPEX going from this. So what we're saying is, if you're charging, as Kambi was, at the time it was between 10 and 15%, now we believe it's between 8 and 15% and moving lower, at what point, if you get big enough, does it make sense for you to just insource? And what this gold box is showing you is the range of their pricing, and if you come below the lower end of that, you're now in the range where people are saying, well, why am I paying you all this money? I should do this myself and have more independence, quicker development, and whatnot. And what you'll see is this gray line here, for example, this is over here would be when DraftKings knew that they were growing rapidly. They come and try to buy the company. They try to negotiate on price. Kambi says, no, no, no. They buy a competitor. They knew where they were going. They knew where they were going to be here. And that made no sense. Clearly, the rational response would have been to maintain the liquidity pool, which is very important for the product, for them to just lower this lower limit for pricing, that sliding scale. But they refused to do so. They were stubborn. Now, this assumes, or what I said in the prior slide, assumes to some degree that price or that cost example was the sole reason that people insourced, or why the others followed DraftKings. It's an understandable thing to estimate. That's a very naive extrapolation we've done before. It's a lot more expensive than that in different ways, and it takes quite a lot of time with a lot of opportunity cost of profit. So we think that DraftKings did this sincerely. They're a technology company, had been for a long time, wanted to control their own destiny. They were absolutely adamant about this. The only way you could have gotten them was lowering that price very dramatically. The people who followed, however, like Penn and Barstool Sports and Kindred even, who they'd come out of, we don't think that's the case at all. We think that was, they said it was, we don't think that's true. What we think happened was they saw the share price reaction that DraftKings got, which was a 7-fold increase in less than 2 years, and they said, I want some of that. Okay, and if you remember going back in time to when this was happening around 2020, this was the time when everyone wanted to vertically integrate. Uber wanted to have autonomous driving. This was the idea. Capital was free. So it was a very popular conjecture and perception in the marketplace. They went for it. And the reason I mention this, in case you think I'm speculating, the business that Penn bought, The Score, it was a fantasy sportsbook provider in Canada. It did not have sportsbook technology. It didn't exist. Okay? But they announced in their press release that that's what they bought it for. So we're always suspicious when they buy it for a product that does not exist. For Kindred, for example, they were building a sportsbook too. The co-founder of the two companies, Kambi and Kindred, Anders Strom, famously came out and gave an interview saying they're building the sportsbook for the 1990s. Okay, and both have had problems actually building this up, being on schedule, getting it done on cost. So we think they were really doing it for market perception, not just for cost. And the cost, from our perspective, has probably been much higher than they realized. So, getting to summarize what we discussed so far, what were the problems before? Well, it was both in product. It was take it or leave it, which wasn't going to work. It was on pricing. They would not move the lower end of this range, even though they should, to maintain share. It was consolidation in Europe and the US growing faster than they expected. So the environment and industry structure changed, and they didn't adapt to that. And then it was a lack of control of key business elements, not giving customers what they wanted. Reason for hope, why we're here today? Well, first of all, they've got a new CEO and a new strategy. Werner Becker came in. He was at Sportsradar before, who are specialists in some of the modules that Kambi are about to go into. On the larger clients, they have seen the light. They're not announcing this publicly, but if you go and do channel checks and you speak to some of the larger gambling operators, they know that Kambi are willing to adjust on price, and quite substantially so. They're never going to release exactly where that is, but they're getting there. Better to have some share of a small pool and maintain this critical thing, which is the most valuable asset they have. It's the live liquidity pool they have. They're the 5th biggest trader in the world, and that's where the value of their data comes from. Better to have a lot more of that at a lower price, and especially with a fixed cost base, than have nothing. So they've changed the approach there. They're also going into modules. So the stuff that people wanted before, if they wanted you to trade for all of their sports books or for just certain markets. So you can imagine if you're DraftKings, you may not want to trade Bosnian basketball. You can outsource that to Kambi now. That wasn't an option before. Equally, when it comes to odds feed, you can get a live odds feed. The rest of the odds feed products that are out there are scraped prices. If you've ever traded bonds, you'll see these prices. You get IDC at the end of the month or scraped bond prices. Good luck trying to execute on those. The prices they give are live. And actually the data is so good now, they've got their AI tool, they will often predict events from sharp bettors, information coming from the bet, before the data from the proprietary suppliers coming into you. They see it before you do, okay? They perceive it faster. The downside from this is that the take rates are lower. They only get 5 to 6% as opposed to the 8 to 10, or 2 to 3 for odds feed. But the addressable market for this is nearly threefold. Much, much bigger, okay? And it doesn't mean they've given up their turnkey business. They still have that, but now they're open to smaller customers. And what we think they'll do with both of these is they're going to sneak in. People are going to see how good the product is, and they're gradually going to take more and more services on. These are the first 2 modules they're offering. They're focusing on odds feed first. Modular plays beyond that will come in, including their bet builder product, which is the parlay or multiplier bets. It's one of the best in the world behind Bet365. So that was their problem before. We think they've learned their lesson. They know they've got to give a color other than black. They both learned it the hard way. Just to very quickly cover it, this is a summary of Sportsradar. So Sportsradar is also a supplier in the industry. They have a lot of proprietary data. I know that Andrew mentioned them earlier. It's a very good business. They pay a lot for that proprietary data. As part of their business, they also do odds feed and MTS. Those sit within these 2 first segments. So about $1 billion of the 1.3 billion is there, and about 300 million of the 1.3 billion is from odds feed and MTS. I show you this just to give you context and show you that you actually can grow in this market. You can do quite well, and the market will reward you. And that is after, as Andrew pointed out, the multiples have fallen pretty rapidly for Sportsradar. So here we have a proxy. This is Sportsradar. They give us their liquidity pool. They give us some idea of what the coverage is. As I mentioned, Werner was at this company before. He knows he knows these segments very well. He helped to manage them. So we're not far off. We're pretty sure of that in these estimates. So we think they're making roughly 80 million a year just from odds feed. That's at that 2 to 3% take rate, and roughly 200 million or so a year from managed trading services. What you have below is our proxy for Kambi. Now, we're using a low end on the liquidity pool. They're already north of this. We're using roughly similar coverage, and we're using the same. We're using actually lower pricing, as you can see. And that is important to note, because it is a better product, dramatically better product. And if you ask people in the industry, they will tell you that. There's a question as to why the adoption hasn't been more rapid, but I think that's because they're perceived as weak and people are trying to push them on pricing. So there's a bit of tension going on there. So if I compare this, and just for reference, when are we saying this is for? This would be our estimate in a bull case for 2030. So keep in mind, 81 million there. Most of that would drop to the bottom line as well, to EBITDA. The revenue last year was 162 million, and the EBITDA was 16. So plenty of potential just from this module. And then let me go through this. Sorry, I put my notes aside. Forgive me. Yeah. So getting to the revenue side and where growth is coming from, and I'm mindful of time. We've just put an array of different images here, but there's actually multiple sources of income that people aren't paying enough attention to. The first one was they won the Ontario Lottery Group, actually from their former parent, FDJ Kindred, who had to give it up. That doesn't sound like a lot. It's just it's the national lottery in Ontario, but it's worth 8 million a year. Again, for a business that did 162 million in revenue and 8 million in EBITDA, that is a huge uptick. And it, in effect, takes care of the roll-off payments from some of the clients who are leaving, or the parachutes that are gone. So that offsets the headwinds. Why do I mention this? Because there are 2 other regions in Canada where their lotteries are looking to outsource, and there's virtually no one else who can do this. It's them, maybe 1, perhaps 2 other players. There are some in Asia where that could happen as well. So that's a big positive. It was their first time also dealing with someone who had that many points of sale. It took about 6 months to get it on board. The cost for onboarding that late last year affected earnings too, probably to the effect of 2 million. Away from this, as I mentioned, and you'll see some of these small things down here, tribal casinos, they did still win small clients for turnkey last year, that original product. They won 6 of them. Doesn't sound like a lot, but they have a minimum guarantee for all of these customers of around $500,000 a year. So that's about $3 million a year. And again, doesn't sound like much until you put it on a 6 million EBITDA. Also, they opened up odds feed for the first time last year. They got one customer in first, which was Hard Rock, and they were only doing that for tennis in one market. In the first year, from 3 clients on average, but maybe 1.25 over the course of most of the year, because most signed up at the late end, they made $2 million, and that was with one sport to start with for the Hard Rock in Florida. Expanded to more sports. They don't disclose that, so it's always very difficult to tell. You don't know how many sports the odds feed's for. The pricing actually varies quite a lot depending on what sport it is. It'll be lower than 2% for Premier League football, a lot more for Bosnian basketball, but they've also signed 6 customers for odds feed alone. You should expect in the next 2 years, those customers may well take on managed trading services for the same sports because it's a lot more efficient. And when I say efficient, it means more profitable, so better for the operator, but also much better for the end customer. The bet time or bet openness is the availability window is much, much greater. So those are the main things. But away from that, I think it's important there were extensions. So a lot of their key customers extended further. Most of the names you wouldn't know. But most of the smaller customers that you would be concerned about, maybe the 6th, 7th, 8th, they extended for multiple years last year. And there's something notable here too. So I had mentioned before that Penn went, Kindred, their parent, left, Shakespearean tragedy. I must mention to you that Penn originally expected to have migrated by mid-2025. Kindred expected to have gone by early 2026. They've both extended multiple times. So Penn just announced that they've extended through July 2027. And I would bet you anything you like that's going to be extended further because it is, for lack of a better term, a shit show, what they're trying to do internally. Kindred, or FDJ, who bought them, have been pretty adamant since FDJ bought Kindred that they were going to stick to the plan of the Kindred Sportsbook, that they were going to go with this. They've been religious about this in all of their public discussions and disclosures. It was something that was kind of criticized at the time of the acquisition. Something has changed there in the last month. The person who they hired as CEO or brought across the CEO of Kindred left for personal reasons. And if you speak to FDJ management now, you will get a tacit acknowledgement. We have a colleague who spoke to them about 9 days ago, and they are now saying that actually, leaving at the end of 26 is not going to be viable. It's probably going to be more like end of 27. They haven't come out and say that, but they're kind of gently going around in roadshows telling people this. Kambi's management are understandably quite chastened by missing lots of expectations over the years, so they're not going to mention that till they see the whites of their eyes. One more last thing was Wisconsin. Some of you who follow this may have seen that they voted in their house to legalize sports gambling, but in a very particular way. So only through Native American casino land. So it's basically a monopoly for the 8 tribes that are there, which is very good news for Kambi because they are the #1 supplier to those tribes around America. They're loved, and actually in Wisconsin, you can already do that in their casino. This just allows you to do it online with their app. The biggest casino there is already a client of Kambi. There's 2 others of the 7 or 8 who are out for tender. They have a good chance of winning this because their product is a lot better. That alone next year, you won't see the results of that this year. That'll come next year. That could be up to 5 million. At a minimum, it will be 1 million. So lots of reasons for hope. And away from that, you have more modules. Like I said, Bet Builder, the parlay product, that would get huge adoption. Brazil, it opened up last year. It's been a disappointment thus far due to channelization. They did not win as many clients as they expected, but there's tenders coming for a lot of operators in that market who are currently very dissatisfied with their supplier. Their product isn't working very well. And then the last one is there could be new markets in the next few years, such as India, Japan, very large markets that regulate, or indeed Texas and California. And if they do it in California, very likely they do it the way they did in Wisconsin with the tribes, which would be very friendly to Kambi. Okay, that was the revenue side. So there's reasons for hope there, and the headwinds are really diminishing. So the number of clients leaving is getting smaller. It might be 10 million at most this year and next year. What about the cost side? Because that's been an issue for them, as you saw with the negative operating leverage and the margins dropping. And there's some hope here too. So what this is showing you is just progression of the total OPEX. I take out the data supplier cost because this is a pass-through. It's really a cog. And what you'll see is it grew pretty rapidly, but it's reversed here. And why is that? It's because of their AI trading division. So they've been working on this product for 5 years. They have the industry-leading product. 50% of all the bets they take now are run by AI. 100% of the World Cup bets this summer will be run by the AI tool, and 100% of all bets in all sports will be taken there in the next 2 years. And this is a couple of implications. The first one you will see is in if I can name it, salary costs. So see, this is reversed. They've already let go of 100 traders. They'll probably be able to let go of 100 more. So the salary cost is going to stay flat or diminish likely for the next 2 years. Concomitantly to that, they need less office space. And so that's diminishing too in other costs. Data supply costs, nothing they can do about that. That's going to continue to grow. DNA, that is what it is. As for other costs, it is what it is as well. But we think that costs are going to be flat at least this year, year over year. Very likely they're flat next year, only moderately increase, while you've got the potential for large revenue increases there as well. So getting to brass tacks, why we're here, why you should care, what I opened with, which is I don't think there's a lot of downside. If we go back to the example I gave you with that gold box, GGR, percentage of revenues, we've just done a proxy for that here. So if you took 60 million a year over 4 years, if you were trying to do it in a rush and pay a bit more, and it takes time to build this, it's like the old Warren Buffett joke, you cannot make a baby in 1 month by getting 9 women pregnant simultaneously. Similar for this, it just takes time. A lot of it has to be done sequentially and tested. It's not easy to do well. So 60 million a year we think is relatively conservative. 4 years, it's very conservative. Look at the example of Penn and Kindred, and they had a lot of experience, Kindred, right? They're going on, for Penn, it's going towards 6, it'll be 7 years plus by the time they exit. If they do get out at the end of 27, Kindred will be 6 years. So obviously a lot harder than people think. And you get to roughly where the share price is today, around roughly 7. We also asked the CEO in a moment of candor at a conference what he thought off the top of his head, and he said at least 200 million, probably quite a lot more. And just take into account, SB Tech was bought for $1 billion by DraftKings. The Score was bought for $2 billion. We're not saying those valuations or anything like it is going to be seen here, but it sure is a lot easier to buy something like this than to try and build it for 4 or 5 years, not to mention the opportunity cost of the profits that you lose. Then coming to a more conventional way of looking at things, we just have this up here for illustration. So if I look at consensus here, what is that assuming? Just very simply, and I promise I'll end it then. This is assuming a 5% CAGR from 2025 on revenues. It's also assuming, if you look, that there's no growth in EBITDA or negative operating leverage. And I'd like you to think back to what we discussed before. What was the underlying growth, excluding those 3 top customers leaving them? It was 13% a year from 21 to 25. If you take that back to 2013, when the company spun out, the growth rate for those customers was 30% per year. In both cases, that's faster than the markets, okay? And this also ignores the Tesseract issue I just told you about on costs, right? I don't think either are realistic. So the market's not paying attention. They're not really on top of what's going on. For our assumptions here, it's fairly simple. I can tell you it's roughly 7.8% CAGR in revenues, so it's about half what they had before, right? In the bull case, it's about 14%, which is that underlying growth rate. That could come from any mix of the turnkey, modular, you name it. And here we just have moderate operating leverage. So margins going back to 17% for 40 million in EBITDA, margins going to 26% in the upper case, again, from operating leverage. I don't think any of you would assume that these are crazy assumptions or heroic or unrealistic, especially given the facts I've given you, but that's what we've got here. And what does that mean for a potential investor? I'll keep, again, this very simple. Those are the same scenarios. Here's what the multiples would look like if you bought in today and you ended up at that level. And what does it mean? Well, on the bear case, it's fairly simple. I'll just assume replacement cost. So we don't think you'll lose money. Why? Because if it stays around this level, someone in the industry is going to buy this. The most likely candidate, I would guess, is Sportradar. Why? Because they're a big supplier of data. It would be a big cost saving for them. And also they have a turnkey book as well. It's a very inferior product. Their odds feed is scraped. Their MTS is not so great, but they have 200 to 800 clients across those different services. They could push this down dramatically. So the distribution effect would just be through the roof. There are people sniffing around this. There you go. And in the base case, we just assume that you get to an exit multiple around 14.5. And that's from the substantial growth in EBITDA. If you did that, you would get a 25% IRR, so a pretty good outcome. You can cut that multiple to exit multiple to 10 if you like. You're still going to end up in the mid-teens. And in the bull scenario, again, which is just 14% growth, which is what happened with those underlying customers, X the big ones, operating leverage, well, we assume an exit multiple of 17. Again, I don't think that's unreasonable for a business going from 16 million in EBITDA to 82 in about 5 years. And if that's the case, you'd make 46% per year. Again, if you drop the exit multiple to 10 at that time, you're still going to make comfortably 25% a year. So in short, very hard to lose, very easy to double your money, and very much misunderstood. So nobody covering it, nobody cares, and everyone really beaten down by a bad experience in the past. And then I'm open to questions.
Thank you. Thank you. Any question? Does anybody have a question? No? Okay. Thank you so much, Shaun. Thank you.